What's up everyone, my name's Robbie, this is Robbie Manila, and today we're talking about a stock market screen that during a 12-year period returned over 1,000%. Now the backtest and screen we're looking at today was run in Europe by valuesignals.com. The screen was run over a 12-year period from June of 1999 to June of 2011. And so this time period, as you might know, was not a very good time period for the stock market. There weren't one, but two recessions and also two bear markets, and oh, by the way, the dot-com bubble happened during this time. So over this time period, the market only went up by 30% over that whole 12 years, which ended up being about a 2.225 rate of return annually. And so essentially, this was just a 12-year sideways market. And the fact that this time period was so bad for stocks, yet the screen we're going to look at today backtested so well, is kind of crazy. Over the time period that we talked about that only saw a 30% gain total in the stock market, the screen returned a 1,157% return, which turns into a cool 23.5% annual rate of return. And to put this into perspective, a $10,000 account would have grown to $163,257 over a 12-year period. And so, not too bad of a return. And so in this video, we're gonna go over three different things. First, I'm gonna discuss the findings of the backtest so you can understand it. And second, I'm gonna show you how to run the stock screener so you can potentially find these stocks and build a portfolio. And finally, third, I'm gonna show you how to find a spreadsheet that I've made that's gonna track these results going forward from the day I run the screen. That way you can look at the screen a year later, or 10 years later, or I don't know, maybe 100 years later if the internet isn't broken yet. And so I hope you're excited because I am. So let's go ahead, let's run this intro, and let's get started. Okay, well, let's go ahead and get into the video, but first, please backtest the like button. Now, you can do this by, just tap the like button, it turns blue, that means you backtested it. Don't ask any more questions. Before we move on, disclaimer, I'm not a financial advisor, not anymore, and I don't have a securities license. This is just a backtest that was done by valuesignals.com. I'm gonna try to recreate it just to show you what it looks like, how it's done. Past performance is not indicative of future returns. This does not mean that this backtest is gonna work today. It might not. Okay, so now that that is out of the way, let's look at the backtest. Okay, so this is the backtest from valuesignals.com. Now, the first thing they did was they tested single factors. And you may be asking yourself, what are single factors? So single factor would be just testing, like, for example, earnings yield. So you test earnings yield to see if earnings yield had a better return over this time period, or price to book, or price to sales, right? So you take these different factors and you test only one factor and you see which ones did the best, perform the best over this 12-year period of time. So looking at the results from the single factor, what you'll see is that first, they broke this down into the first quintile outperforms the fifth quintile. Am I saying that right? Quintile? Anyway, so that's the first thing they're looking at. Then they want to see linear returns. Then they want to see a consistent outperformance, and then they want to say, or they say, that the result is either strong or weak. So you want to see that these different factors on the left are also going to have an actual strong result. And so earnings yield, the 12-month earnings yield, had a strong result in the backtest, and then the price to book had a strong result in the backtest. Now remember, this is just the single factor backtest. And for the single factor backtest, the best performing over this time period, the 12 years, was around 400%. Now, remember, the market only did about 30% over this time period, so that performed very well. But the thing is, once they started combining factors, they actually got even better results. And so what do I mean by that? Well, take a look at this. So you'll see on this chart is a combination factor where they combined price to sales with all of the other different factors. So what they did was they took price to sales, that factor, they sorted all 1,250 companies based on price to sales. The lowest of those companies were in the first quintile. So the first 250 companies made the first quintile. So then, in this one here on Q1, that first quintile was then sorted based on earnings yield in this one. Then let's say was then sorted on this one by price to book. And so that's what they did. They sorted the best or the lowest price to sales ratios, and then they took the lowest or highest of whichever these factors is better. So for example, a price to book, you would want a lower price to book, right? So they took the lowest price to books after they sorted the price to sales, and they sorted those. And that ended up with a price to book of 423% return. Now, this is good. A 423% return is great, and all of these actually did pretty well. But the thing is, like I said, the factor we want to see is what performed the best. So let's take a look at that now. And so the best strategy of this whole backtest ended up being a combination factor, with the first factor being a price index, a 6-month price index, which I'll explain what that is, combined with then a price to book. So what is that? Well, the 6-month price index is essentially like a momentum screen. So what they're doing is they're taking the highest gaining stocks over a 6-month period, and they're sorting those. So the stocks that did the best out of those 1,250 stocks that we mentioned, the highest growing stocks were the first stocks in the first quintile. Once they sorted all those stocks into quintiles, they took the best quintile, so are the top 250 best performing stocks, and then they sorted those by price to book. And if you're confused about this, when I run the screen, you'll probably get a much better understanding about what this is, but for now, just bear with me. So what did that yield? So take a look at this. By combining the first factor, which is the 6-month price index, by the second factor, the price to book, the total return was 1,157.5% over that 12-year period. This was a compound annual growth rate of 23.5%, and the years that it outperformed the market was 83% of the years that they tested. So 83% of all years, this thing outperformed. And the number of years with negative returns was only 3 years. So this was the best performing out of the combined factors and single factors, and it was a monster return over that 12 years. Remember, that 12-year period was a very bad period for stocks. Now I'm going to give you two options to run this screen. I'm personally going to run the screen on Charles Schwab because I have a Charles Schwab account and they have a built-in screener. And if you don't have Charles Schwab, you should be able to do this with a Fidelity or a Vanguard, or a lot of these brokers, they do have built-in screeners, so you should be able to do what I'm going to do now. Now, if you don't have a broker that has a screener, I'm going to show you a company that you can potentially use. It's called Finviz. I got an affiliate link below if you want to use that, if you set up an account. Just, to support my channel, I would appreciate that. So we can use Finviz to do this, but I'm not going to go through the whole thing about how to do this in Finviz. I'm going to do it in Charles Schwab. But once you have some of the factors here, you can just follow along what I do in Charles Schwab and it should translate. So the first thing you'll probably want to do is find price to book. So I have price to book here. And now here's the thing with Finviz. I don't have an elite plan, so you would have to probably sign up for the plan to do this. But you'd want to do this custom, so that you can get all price to book value stocks. Then you'd want to see the change. So the change is over here, and you'd go with the probably anything that's up. So essentially you'd have this box, the price to book box. You could eventually sort it by clicking down here, export. So if you want to export it, then you gotta sign up for Finviz. And again, you could check my affiliate link below if you want to do that. But I'm gonna now go to Charles Schwab. So I'm in Charles Schwab, and what I did was I went to research and then I went to screeners. You'll end up on this page, and over here on the left side, you'll see the criteria that you can use to run the screen. So I've added my criteria, but we're gonna go over what I've added. So on the left side, you see the different criteria that I have added to this. Now the first thing you'll see is the sectors and industries. What I did was I took the sectors and industries, which is this one. I took out all financials, and I took out real estate, because as you remember, the screen the back test did screen out these two different things. They screened out financials and real estate, insurance companies also, things like that, which fall under financials. So we're taking that out. Next, we have the universe. I only want domestic in this one, so we have domestic for the universe. Then we have market cap. So I did my own thing for market cap because I didn't want micro cap companies, so I'm doing small, mid, and large. And then the exchange, I have NASDAQ and the NYSE. And so that's up here on the left too. So these are all the things on the what's called the basic criteria. Next, we have price performance. which is the 6-month price index that we want to add. So what we do is we go to price performance, price change. We have the last 6 months. So this is going to show the price change in all stocks for the last 6 months that are in our screen so far. We go down here, we see price change last 6 months. I don't want to put any values in because I want to see all of the price change for all stocks when I export this over the past 6 months. Also, I want to go to valuation because I want to add the price to book value. So the price to book value is here. It's the most recent quarter. That's what MRQ stands for. So what you want to maybe do is you could run this around the time where most companies have reported earnings already. That might be more accurate. So do that if you can. If not, then just go ahead and do this whenever. But I have here price to book. Again, I didn't put anything here because I want to see the price to book of all of these companies. And so what this has done is it's created a list of 1,451 different companies. And it's going to show me all the different data I need to then sort this. So now I'm going to hit export. So when you export with Charles Schwab, they only allow you to do 1,000 companies, unfortunately. So what you're going to do is you're going to use a quintile being 200 companies, which we'll go over in a second. And so now I have the Excel spreadsheet I've opened up that I just downloaded from Charles Schwab. What I'm going to do is I'm going to add tables. So I'm going to highlight everything and I'm going to add a table. So I highlighted all my data. I go up to insert here and then I hit add table. Now I'm doing two things. The first thing I'm going to do is I'm going to sort based on the price index. I'm going to get my top quintile of those, so the first best 200 of those companies, and then I'm going to sort based on price to book. So I'll do that now. So I'll go up here, I'm going to hit largest to smallest. I'm going to actually take out all of these that don't have price indexes in it. And now I'm going to go down to number 200 and I'm going to delete everything else because I only want to keep my top quintile. And so now I have the top 200 companies based on price index. Next, I'm going to take the price to book. And what I'm going to do is I'm going to sort this on lowest to highest. And so now we have the top 200 companies based on first the best quintile of price change over 6 months, but then that are sorted based on price to book value. Now, this is a crazy screen and it's because the price index change, so these here are oftentimes they're momentum stocks. And momentum stocks, you think of them as growth stocks, but now we actually have a screen that's also throwing in like a value element to it. So these are all kind of, price to book, low price to book stocks are supposed to be more value companies. So now we have this kind of like momentum value screen, which is kind of a crazy type screen. Not something I've ever really thought about doing before, but you know what? I'm actually excited about this. So now what I'm going to do is only keep the top quintile of the price to book stocks as well. So because I'm down to 200 stocks, I'm going to take the first quintile of those, which is the best 40 stocks. So I'm going to go down here and I'm going to keep only the best 40 stocks. Everything else I'm going to delete. In here I hit delete, and now I have the portfolio of stocks that I've screened for. And this is the portfolio that I'm actually going to now add to a Google spreadsheet that you all can take a look and see how this thing performs going forward. And so now here's the Google spreadsheet. So if you want to see the spreadsheet, in the link below, there's a little link. It'll say link to the Google spreadsheet. Hit that. You can take a look at this whenever you want to. Now quickly about this spreadsheet, what it's showing is all the different tickers here, the names of the companies that we just sorted for or just screened for, the current price of the company, the price when added, so this is going to change, and we'll see how much this is gained over time for each company. Then we have the S&P 500, which is the ETF SPY that we're using to measure the S&P 500. And we're going to measure how this portfolio does versus the S&P 500. So here you'll see how each of these stocks perform over the S&P 500 over time. Down here, you're going to see the average of all of these. And then here, you're going to see if this thing underperforms or overperforms. So if it does, it's going to be here, and it's going to be how much over or under it performs the S&P 500. The part under here is going to be the actual return for the portfolio for the time period, and then this is going to be the S&P 500's return for the time period as well. So remember, when you're looking at this to see if this is outperforming or not, you just go here to this little gray box with the green letters. And if it's positive, it's overperformed the S&P 500 by that much. If it's negative, it's underperformed. And so before we go, there are two more things that I want to make sure that you understand about this portfolio. The first thing is that it is equally weighted. meaning that because we had 40 stocks here, each of these stocks will have the exact same position weighting in your portfolio. So each of these stocks should be 2.5% of your portfolio. You shouldn't weight it based on which stocks you like. You shouldn't put the most money in a stock that you like. You should equally weight all of these. The next thing you should know is that they held this portfolio for 1 year and then they cycled the portfolio after they ran the screen again a year later. So essentially, if I ran the screen on March 2nd of 2021, maybe on March 3rd of 2022, I would run it again and I would change out my whole portfolio. And so I hope you enjoyed this video. Take a look at the link below if you want to see the screen, see how that thing does going forward. It'll be really interesting to see. And of course, if you like this video, if you got value out of it, please hit that like button and subscribe if you want to see future content like this. So that's all we have for this video. Thanks so much for watching, and please watch another one of my videos on the end screen right now.